Welcome to the Daily Update, where I'll go over the action in the market for Thursday, May 25th, and then we'll see how things look for Friday, May 26th. We had a nice little bounce. Unfortunately, it didn't really do a lot to help the internal structure of the market overall. We're still showing some weakness. Nvidia came out with their earnings report, and they just went up massively, and other stocks went up as well. But the broad market really is still looking kind of negative overall. The S&P, the NASDAQ 100, and the NASDAQ were up, where the Dow ended up being down, but it's still showing some improvement in our charts. Incidentally, I have an unexpected appointment that I have to go to right after recording this video, so it's going to be a little bit shorter and probably not as edited as usual. Before I start, I do have a supplemental video that you're welcome to check out that's about 2.5 weeks old now. I do have a PDF of all the slides and charts. Please click in the description below the video and see if that helps you to hone in on some of the charts that are a little hard to see, because I can no longer do the zooming. It's just too much on my computer, and I have a gaming level computer. I do have a private Facebook group that you're welcome to join. I do have a poll that you're welcome to take part in. And I also post on Rumble in case you are not able to find me on YouTube. So let's go back and talk about what happened. At the open, we had a gap higher open. We went above R2 at 41.46, but then we quickly fell back down to R1 at 41.31. We chopped around between R1 and R2 before we finally broke above R2. We never got to R3, so I didn't put that on the chart. We closed above R2. We ended up being up 0.88% on below average volume. And the technicals, as I said, we're showing some strength in areas, but overall we're still seeing some things turning more negative because of this inflation and interest rate scenario, but it's the debt ceiling that's kind of driving everything right now. What are some comments that we can make? There's still a lot of uncertainty about the debt ceiling. There's no deal right now, but there is a slimmed down version with some narrowing differences. They're coming a little bit closer together. Congressional members are leaving for Memorial Day. They've got to have their vacation, you know. But they were warned that they might need to return on 24 hours notice if a debt ceiling deal is reached. Fitch came out. They're one of the ratings agencies, and they put our AAA rating on credit watch negative. Nvidia, this is what really drove the market on Thursday. They were up 24.4%. They had a really strong earnings report, and they had really strong guidance going forward. But what was causing a little bit of angst in the market is Germany's GDP is showing some weakness. The NASDAQ and NASDAQ 100 were up strong. The broad market is still showing overall weakness. The 4100 level, if we continue to fall, is offering support. If we start to go up, we're still looking at resistance at 4200. The dollar was up and interest rates were also up, so that could have put some headwinds on stocks. We still have all of our yield curves that remain inverted, mainly the 10 to the 2-year and the 10 to the 3-month. Sentiment is still positive. It ticked up to 63 where it had been at 60. Our trend is positive with the green line on top, and it did turn back up, but overall the ADX is weakening. It's just barely below its moving average now, and both of those are below 20. I've changed our bias to mixed. Even with the update, we still saw some internal weakness, and our momentum is now at mixed. What about the economic reports? We had the second estimate for GDP coming out for the first quarter. They actually revised it up to 1.3%, where they had expected 1.1%. Last time we got the first estimate, it was at 1.1%. The deflator came in at 4.2%, where they expected it at 4%. Last time it came out at 4%. Weekly jobless claims fell to 229,000. They expected to have 248,000. Last time we had 225,000. Continuous claims are coming in down just a little bit at 1.794 million. Now, I don't have the Isabel Net blog charts to show you today. I'm just going to go through my own charts for this video. The intraday chart showing how we really gapped up. We blew right through R2 right off the bat, and then there was a lot of selling coming into the market. We chopped sideways, got back up to R2, came down to R1, went back up to R2. Finally, we're able to break above R2, danced around a little bit. R2 now became support, and we closed a bit above R2. Here's the intraday chart where we had been a little bit stronger in the initial overnight session. Then we fell back. Then things were looking a little bit better, only to see some weakness, the selling going into that strength, and then we chopped higher for most of the session, and we're trailing off a bit in the initial overnight session. Growth still continues to outperform value, where growth was up 1.56%, where value was virtually unchanged. Mid caps, they were the same, and small cap growth did outperform small cap value. Here's the intraday chart showing how growth just spurt up and is still doing well overall. Even when we saw some weakness in the market, growth has been holding up fairly well. So this could be the smart money coming in and buying growth on this weakness with the idea that down the road, it's going to go up and things will be a lot more positive. Then looking at the charts for the economic reports, we had the weekly jobless claims. They ticked up slightly, but our 4-week moving average is pretty much going sideways. The continuing claims are starting to fall off a bit. This could still suggest that the Fed may come in and continue to raise interest rates. Looking at sentiment, our Ulcer Index, it ticked up just a little bit even with the up day. But the VIX, after coming back up to 20, has now dropped down below 20, both on the line chart and on the bar chart. The VIX of the VIX, after showing an increase of volatility, is now ticking back down. The equity put call ratio continues to fall overall. We're not really working off of a signal right now, but as this falls, that generally means the market is going up since people are hedging their positions less. One fear gauge ticked down just slightly, but we're still headed up overall with this chart, and we're pretty much flat to sideways, even though we advanced just a little bit with this other fear chart that we look at. We're still switching, it looks like, from a risk-off posture back into a risk-on posture where this chart continues to go up. Our advanced decline line, we did see a little bit of a fall based on price. We also saw it pretty much flat based on volume. We're still seeing a short-term negative divergence since the volume is below the moving average, and we're also working off of a longer-term divergence where price was outperforming volume. We did see a little bit of an increase with the new lows, so we're turning back down with our 5-period moving average and rolling over just a bit with our 10-period. The advanced decline ratio still remains below 0, and it actually declined. Accumulation distribution is right about on the moving average and turned up slightly. We're also working off of a longer-term negative divergence with the cumulative advanced decline line as well as the regular advanced decline line, and they both declined. And we're breaking a little bit below the advanced decline line here for the NYSE. That's another negative divergence. We're also working off of a longer-term negative divergence when we look at common stock based on price and volume. Looking at our broader range advanced decline study where the NYSE is falling, the S&P actually fell, as well as the mid caps and the small caps. So you can kind of see it looked good as a headline number, but we're seeing some real weakness under the surface. Looking at our trend, you can see the ADX has now come back down and it's just a little bit below its moving average. The green line is on top and advancing, so that's positive, but we're still below 20 overall, and we need the ADX to turn back up to show that the trend is getting stronger. Volume did pick up just a little bit in Thursday's session. Looking at some short-term charts where we're coming down to this pivot level, we actually dropped a little bit below it. It's a little bit hard to see. You can see where there was a pickup in volume in Thursday's session. Our moving average study ticking back up with the 20, 50, and still declining with our 200-period exponential moving averages. We're back above both the 20 simple and exponential moving averages now, so in the short term, that's more positive. The Stochc RSI, which had been extreme negative, has now bounced back up. The force index has crossed back above 0. Our stochastic study, we're turning back up in the short term. We're still declining in the intermediate term, and we're still rolling over with the long-term stochastic. Intermediate term, we're still below the dashed line and declining with the balance of power. The go-no-go system remains neutral with the lighter shade of blue. The TTM squeeze is looking a little bit better right now, but is pretty much chopping sideways. The PPO is still positive in the long term, intermediate term. We came just barely back above 0 in the short term. Our rune indicator hasn't changed, but is still positive overall. The McClellan oscillator, we're getting back down to this extreme negative reading. And the NYSE McClellan oscillator continues to show weakness. The summation index based on price is declining, and we're also turning back down based on volume. The Swenlin trading oscillator is declining based on price and volume. The PMO is starting to roll back over negative. We're still negative based on price, and we're rolling back over based on volume. The PMO study ticked up just a little bit. We still have this longer-term negative divergence. We're declining with the buy signals, and we're also declining with the PMOs that are above zero. We've gone back to neutral for the Elder Impulse system for the S&P. This chart is encouraging in that even after the fall, the parabolic SAR system still has the dots underneath, so that is positive. We're still above the 50-period moving averages. We're coming down to this exponential moving average, but we were able to launch off of that in Thursday's session. The slope is now turning back more negative. The MACD is also crossing over negative. So when you look at all of our oscillators, we're switching back over to a more negative look, even though the longer-term oscillators are still trying to show some improvement. We're back to being above all of the plotted moving averages in our moving average tree. We dropped below 50 with the BPI, so that is more negative. The NYSE bullish percent index also turned down and is still below 50. The Chaikin money flow did decline, but it's still above zero. The Chaikin oscillators dropping below the midpoint. That's more negative. The money flow continues to go up. The ultimate oscillator also ticked up, so that's positive. The vortex has the green line on top, and it advanced slightly. The RSI crossed back above 50 with the 14 period as well as the 9 period. On balance volume, we're still below this moving average, even though it improved slightly. We're still seeing this longer-term negative divergence when we look at the 250 period moving averages in the S&P, where they're not participating in this upward movement that we have been seeing. The Copic curve is still generating a buy signal, but it is rolling over just a little bit. And we're coming to the point now where we're getting a Pring bottom fisher signal. That could be positive for the market. Looking at our line studies and Fibonacci charts, we're just below this 4170 level. If we keep going up, this may provide resistance. We're above this 4123 level, so if we fall, that may offer support. And we're coming up to this 4156 level. We're just 5 points below this now. It may not offer much in the way of resistance. If we fall, we're looking at support way down at 4,000 on this chart. And if we also continue to fall, we have another chart suggesting the 4020 level could act as support. We're coming up to this parallel trend line where we hit that and bounce back down. Can we go back and actually break through that? We're coming into a new cycle now. Last Friday was the 50-day cycle. We're wondering if we're going to see a change. This blue line is also a 4080 support level. Our different charts, the Heikin Ashi has more of a doji type looking candle right now. The Kegi is turning back more positive with a black line that's pointing up. The Renko is still positive, and the 3-line break is still positive. Our different indexes, as we've been saying for a while now, the equal weight index is underperforming the S&P. Looking at our new take on Dow theory, we're still above this breakout level on the S&P. The Nasdaq still continues to be above this level where it's breaking out. The transports continue to underperform the Dow. The dollar, it was up in Thursday's session. The Dow has come back up right to its 200-day moving average. The diamonds for the Elder Impulse system still remain negative, and the Nasdaq is coming back up to a previous high. Can it break back above that? But we're seeing this negative divergence. When we take the cumulative new highs minus the new lows, this continues to decline. The Nasdaq is still above this 38.2% retracement level. If we fall, that may end up providing some support. The Nasdaq 100 is also breaking out and reaching new swing highs for this period. And the Elder Impulse system has switched back to positive. The Nasdaq is now broken above, again, this 50% retracement level, so that's positive. And on a longer term basis, we're still looking good with the weekly chart going back to the all-time high. The small caps were down in Thursday's session and still showing some weakness overall. Here's the Russell 2000 index where we're dropping below 50 with the RSI. We're rolling over, but we're still positive with the MACD. Small caps are back to underperforming the S&P 500. And the Elder Impulse system for the small caps remains negative. But if you look at growth overall, it's still performing quite well, even though we ticked down on Thursday. The mid caps are below both moving averages and having a hard time breaking through this resistance level. And the mid caps also remain negative. Mid cap growth is still doing quite well. It actually advanced on Thursday. Looking at Dow theory, where we're seeing a negative divergence longer term with the transports, and shorter term, we're seeing a negative divergence with the utilities. The micro caps are still above 100. When we really watch this is when they drop below 100. The home builders, we were up with the S&P. The home builders were pretty much flat. The ratio was pretty much flat. And the relationship is still strong between the S&P and the home builders ETF. Keeping an eye on the financial sector, we were pretty much unchanged but still negative. The financials are really underperforming the S&P 500, and the regional banking ETF is underperforming the financial sector. Bonds, interest rates were up and bond prices were down. And we're still seeing this longer-term correlation show that bonds and stocks are going in opposite directions. On a shorter-term basis, we're seeing some improvement, but the spread between the two is still pretty wide. Our interest rate studies were still coming back up, which is showing more uncertainty right now. This may have something to do with the debt ceiling and the stronger economic reports that we've received. Now they're unsure about what the Fed's going to do going forward. But the S&P turned back up, so it's headed more towards this soft landing area. Then looking at growth and value, growth is still really outperforming value. Longer term, we're still below this red line with the special K. And then our analysis just shows that the MACD is still above zero and above its moving average, which I keep saying suggests that this breakout above the trend line is legitimate, at least for now. An update of our possible positive scenarios. We're declining with our 19-day exponential moving average of the advanced decline ratio. We're below zero and declining based on price as well as volume. When we look at growth versus value, we're still hanging in there pretty good. We've been going pretty well ever since February. When we look at the Qs to the S&P, that really outperformed, where discretionary has dropped under the moving average. Large cap growth is outperforming large cap value. And then with our growth to value ratios, strong with the large caps, showing improvement with the mid caps, not really showing any strength with the small caps. The S&P to utilities ratio is showing some improvement, and this could give some support to the S&P. But we're still below average when we take our broad measure of the 5-period moving average of the highs minus the lows. This is still negative. Longer term with our indicator, we're still below zero when we look at the 50-period exponential moving average of the new highs minus the new lows. And we're turning down just slightly, but still above zero with our longer term indicator. The Treasury yield, which looked like it was spiking, coming back down, well, now it's starting to go back up. But this is also encouraging. The staples to S&P 500 ratio continues to fall, and that could give some really good support to the S&P. So what's our outlook for Friday? We're still dealing with earnings season. The technicals are showing that we bounced, but we're still turning negative when you look deeper inside of the market. We have personal income and spending coming out. The PCE price index, that's the second major inflation gauge that we watch. Durable goods orders. We'll be getting the advanced international trade in goods, as well as the advanced retail and wholesale inventories, and then we'll get the final reading of consumer sentiment. Then the whole list of geopolitical events, it's pretty much about the debt ceiling for right now. So our Stock Traders Almanac statistics, we're coming up to the end of the week after options expiration. We tend to be positive during this week. When we look at May 26, we're neutral to positive with the Dow as well as the S&P 500, and we're actually more positive with the NASDAQ. We are on the 20th trading day of the month. This will be the Friday before a 3-day weekend, but we tend to be up a little more than down when we look at the dashed green line. We're coming into the end part of May now, where maybe we're putting this weakness in the middle of May behind us, both with the green line and the black line. May also, during a pre-election year, tends to be positive, but it still underperforms the other months in the year. And then this goes back to 2011 when we had the previous debt ceiling crisis. This is what the S&P was doing, and then this black line is what the S&P did after that. Shavaco Capital also has a chart of that same thing. Based on this chart, we might see some weakness coming in later July or early August. So our scenarios, it's kind of hard to go with the down one right now because they're bouncing a little bit, but we're still turning negative overall, but we're just not trending. So it makes it hard to go with the up scenario, especially if we do continue to go up and we get through that 4,200 level. That's going to shift everything more positive. But until that happens, it's really hard to take up positions really serious right now. So we're defaulting to the sideways or neutral trend. Because the ADX is weakening, it's just barely below its moving average. Both are still below 20. The green line is on top and it is advancing, but the ADX itself is not showing any strength. So our warning signs, we still have a lot of these negative divergences that we're dealing with. The VIX is still showing a lot of complacency. The NYSE advanced decline line, it's breaking below that trend line. The NASDAQ cumulative new highs, new lows are also showing weakness. The S&P is underperforming utilities, but we're seeing some real improvement in that chart. The risk-off posture that we're dealing with now could be shifting back more to risk-on. The small caps index is underperforming. The mid caps is also underperforming and generated a recent death cross, but their growth side is looking pretty strong right now. Earnings season continues, but we could be coming to an end at some point. Our positive things, we have a Copic curve generating a buy signal. The Pring bottom fisher may be close to generating a buy signal. The longer term seasonality and setups, those are still positive and apply to the whole year. Lower price levels may provide support. We're looking at 4,100, 4,080, and if we continue to drop the 4,020 level. The NASDAQ is still above its resistance and doing quite well. Small and mid-cap growth is showing strength, especially the mid-caps in Thursday's session. And then if they come to some kind of an agreement, will this produce a short-term rally? So our conclusion, the S&P, it's bouncing, but it's still turning negative overall. Short-term, we're bouncing, but still seeing some weakness. We did see some short-term improvement, but another down day could easily shift that back more to negative. Intermediate term is still looking more negative overall, but in the long term, we're still positive because we're above the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a really good day. Have a wonderful Memorial weekend. I'll look at preparing and posting the videos over the weekend, so I'll talk to you in the next video.